Hi, folks. Welcome to the Getting Your Edge podcast. My name is Dennis.
And hi, I'm Judy Gratton.
And we're here to help you right-size your home and your life. Hello, everyone. My name is Dennis Day, and you have joined me on the Getting Your Edge, How to Right-Size Your Home and Life podcast, brought to you by the fabulous Edge Group team, where we give you an edge in all your real estate needs. This podcast is packed full of information, and it's called Reverse Mortgage, Scam or Savior. Our guest today is Frank Borg of Fairway Mortgage. He's here to talk about reverse mortgages and how they can be a powerful tool to help you stay in your home longer and provide you for some financial security. So let's dive right into it. Frank, please tell us a little bit about you and your Fairway Mortgage company.
For over 30 years, Steve Jacobson founded it as a company to really focus on the consumer and the customer and our borrowers and our business partners. We lend in all 50 states. Some of our traditional loan products include conventional VA, FHA, USDA, renovation loans. So we really are well distributed in terms of the products that we can offer. I began in the mortgage industry back in 2001. I was a performing artist that was transitioning out of a previous career and landed in this career and really have enjoyed it. I've been doing reverse mortgages as my principal type of outreach to educate and provide services to older homeowners as they're moving into their retirement years since 2020. And just very excited for this product and to have the opportunity to share some of the details and the myths and educate your audience on what these loans are all about.
So what performing career?
Yeah,
I'm dying to know. I'm dying.
I started out in life as an actor. I went to college to major in theater and discovered ballet. And
wow.
And so I switched my major to ballet sometime in the middle of my sophomore year, got a dance degree instead of a theater degree. And I danced professionally in Kansas City and Oklahoma City for 5 years.
Wow.
And it was a good time.
I ballet for 11 years, so I know your pain. Although I never did anything professionally. I was in like a non-professional group, but I know your pain.
It was incredibly rewarding.
Yes,
and I still perform. So
do you really? Oh, cool.
Yeah, with a local company here in Edmonds called Olympic Ballet Theater.
I know Olympic Ballet Theater.
Okay. Well, I do their Nutcracker every year, and I just finished Sleeping Beauty over the weekend, and I've done a few other work pieces with them when they need an older character role that has some professional dance experience. It's really fun.
Well, we will have to come and see you. That's
definitely.
Well, Frank, can you give us an idea for people who don't understand what is a reverse mortgage and how does it work? That's probably a huge question. So,
great place to start. So, the first thing to say about a reverse mortgage is, first of all, it's a loan just like any other loan, but it's a special type of loan that allows homeowners 62 or over convert some of their equity into cash, either in the form of monthly payments or a line of credit or lump sum, while they're still living in the home. And so the fundamental difference between a reverse mortgage and a traditional mortgage is that during the term of the reverse mortgage, no monthly mortgage payments are required. The homeowner or the borrower still has to pay their taxes and their insurance and keep the home maintained. But what it does is it allows a homeowner who wants to stay in their home convert some of their equity they've built over time into money to use for any purpose that they'd like, and no payments are required.
What if they currently have a loan on their home? Does that get wrapped? What happens with that loan? How does that work?
Yeah, you were about to actually answer your own question. We really wrapped the mortgage that's in place currently into the reverse mortgage, right? So if somebody has a regular mortgage that they're paying on and they're interested in doing a reverse mortgage, depending upon how much that they can qualify to borrow, and we can go into sort of how much you get maybe in another question, but as long as there is enough equity in the home to cover the payoff balance of that current mortgage, then we just pay off that mortgage and convert that into the reverse mortgage. And in many cases, they have money left over to spend in the way I described earlier. In some cases, it's close. But what they do, even if it's close, what they end up doing is eliminating or making optional the payment that they're currently making on their loan by converting it into a reverse mortgage.
Now, the reverse mortgages has been around a long time. Whenever I mention to people, they immediately think scam. Why is that?
Well, yeah, it has been around quite a while. The first reverse mortgage was done in 1961. I think it was the Federal Housing Finance Authority or whatever the regulatory body was in power at that time, did a pilot program to test this out. If you fast forward into the late 80s, the Federal Housing Administration, overseen by HUD, adopted the reverse mortgage into their program, and they called it the Home Equity Conversion Mortgage. So it has been around a long time. And ever since HUD adopted that program, they have continually updated and made changes to the program depending upon kind of the economic factors, in terms of learning how to make them safer, making sure that borrowers were successful in the program. So there have always been changes. Now, to the part of your question where you talk about this loan being a scam, there were some very well documented problems with the loan program pre-2014, okay? Especially at that moment in the financial crisis around 2008, when equity values dropped, there were some financial hardships. The short version is the program had some flaws in it that allowed loan officers to improperly get someone into one of these loans. So the mortgage itself has never been a scam. However, because prior to some of the changes that I can talk to you about now, there were not safeguards in place to protect borrowers in the instances when a loan officer, in the interest of getting them more money or just making the loan happen, made it possible to put people at risk. And so, I mean, I can give you kind of a specific example of one of those reasons that they think it's a scam and kind of tell you how that's changed, if that would be helpful.
Okay, that would be really helpful. Thank you.
Okay, so I start out a lot of the seminars I do by telling this story. So let's just go back in time, let's just say the years 2000. And, Bob and Mary, they come to me and they want to get a reverse mortgage. And so I talk to them and we go through their scenario and I say, well, okay, this is how much you can get for this loan. This is how much your available equity is and what HUD says I can loan to you. And they say, oh, we were really hoping that we could get a little bit more money. And so as a loan officer back then, and I'm not really considering the risks, I say, well, Bob, you're 12 years older than Mary. And so, one of the things that we could do is we could take Mary off the loan and just use your age because you're older rather than using Mary's age. And because you're older, HUD says I can loan you more money because your life expectancy is shorter. And they say, oh, okay, more is better. So yeah, let's do that. Let's do that. And so everything seems fine for a while. They get their more money that they wanted and everything's going along. But, something happens, 10 years in 2010, let's just say Bob passes away. Something happens and he's gone now. And it's just Mary in the house. Now, under the old rules, because Mary wasn't a borrower on that loan, she did not have the protections and the rights that Bob had when he got the loan. So once Bob passed away or permanently moved out of the house, Mary had to figure out how to pay that loan off. And at this point, Mary's, in her late 70s. And, the market has declined in 2010. There's not enough equity to actually let her get her own reverse mortgage. And she didn't have the financial capability to get a regular mortgage. She didn't have the money to pay it off. So guess what happened to Mary?
She lost her house.
She lost her house. She got foreclosed on.
Oh, boy.
And I'm sure both of you will agree with me. I mean, probably one of the worst things that you can do for your service or product is kick grandma out of her home right after her husband dies.
Mm-hmm.
Right. And so the reason I lead it with this story is because HUD saw this happening, and it happened a lot, not just for that very reason, but for there are other reasons that you can default on a reverse mortgage. But HUD realized that this is a big problem with the program. And so HUD changed the rules. So what they did is they changed the rules to say that even if somebody doesn't want to be on the loan, if you're married, then the non-borrowing spouse, the way they changed the rule is that instead of being able to do what Bob and Mary did initially, there's no option to do that. If Bob and Mary are married, even if for some reason Mary doesn't want to be on that loan, we use her age. We use the youngest spouse's age in calculating how much loan they can get. So if something happens to Bob later on, Mary, as a non-borrowing eligible spouse, still get the deferral that allows her to live in the home the rest of her life without making that mortgage payment. So that one thing changed the whole landscape and made these loans much safer.
So why do you get a higher rate or higher amount of money I get it that they're not around as long, but then wouldn't the home not have as much time to appreciate? Wouldn't it? It seems to me like you should get a higher rate if you're younger than if you're older. Do you understand what I'm saying?
I think I do. So the rationale or the thought behind giving a borrower more loan amount if they're older versus younger has to do with life expectancy, period.
Okay.
Right? So an 85-year-old borrower who gets a reverse mortgage is not going to have that loan statistically as long as a 62-year-old borrower.
So what I'm thinking, though, along those lines, is then the lender is not going to make as much money off that loan either way, either in interest or selling the home and the appreciation is shorter than it would be if someone lives for 3 years or 5 years versus someone living for 10 years in a home. It's going to appreciate differently.
So that's a good point. Once this loan is done, once we originate and close a reverse mortgage, the question of the property value and what happens to that property is moved off the whole table.
Okay.
The only time the property value matters in a reverse mortgage, or two times, is when we set the loan up in the first place, because that helps us determine how much we can loan, because it will be some percentage of the property value up to the maximum that HUD will insure.
And is that based on an appraisal, a current appraisal?
It is. It's based. Yeah, it is. It's based on an appraisal, an FHA appraisal. It's based on the age of the youngest borrower, and it's based on the prevailing interest rates at the time we do the loan.
Okay.
Right. So going back to your question, so yes, I mean, in certain situations, lenders ultimately will make more money on some reverse mortgages and less money on others. And it is a commercial product that lenders will make money on. Mm-hmm. The reason that HUD adopted this, and the reason for this loan, though, is to provide a way for older homeowners to stay in their home longer without being financially compromised. And so HUD says, okay, if you're older, we're going to let you have more of your equity because you're going to use it for less amount of time. Okay. And so maybe in that situation, the lender ultimately will get less interest, you're right, than a younger borrower. But the younger borrower at 62, if we gave them more equity or more access to money, then the chances that that loan is going to grow over and above the property is very high. So we limit how much money we can borrow at the younger age.
I see. Okay, there's the difference.
Does that make sense here?
Yes, it does. Okay. Yeah, it does. Thank you. So age is obviously part of the eligibility to get a reverse mortgage. Are there any other requirements for eligibility for a reverse mortgage?
Sure. You have to own your home. First of all, you have to be on title. You can have a loan on it. It's fine. But you have to own the home and live in the home as your primary residence. Okay. And you have to, we talked about age, you have to be 62 years old. Those are really the only two requirements. Now, if somebody owns their home, but intends to move in a short amount of time, this is, I'm going to sell my house in a couple of years, then this may not be a good solution because, because this loan does cost more than a traditional mortgage. And I can talk about that if you want. But the only two primary requirements are they have to, or three, I'll add one more. They have to have enough equity to do the loan. Let's just say if they have an underlying mortgage already, if they have a mortgage already and it's 85% of the value of their house, then they're not going to be able to benefit in most cases from doing a reverse mortgage, without bringing money of their own to pay that down. Mm-hmm. So equity, age, and intent to live in the property are really the three primary requirements to get a reverse mortgage.
And when you say it costs more, are we talking interest rates? Are we talking upfront fees? What are we referring to in that?
Sure. The upfront fees, which are generally funded out of the loan proceeds, just so you know.
Okay, so they don't have to bring money to the table to do this then necessarily.
In 99.99% of the time, the borrowers do not write a check at closing for any of the upfront fees. So basically, to close one of these, we're going to use a little tiny slice of the equity to fund the closing costs. Okay. And I'll talk about those too. But the rates, actually, they're really lined with current interest rates at the time you do the loan. Okay. So the rate differential is not very different. Now, what makes these loans cost more than your traditional mortgage loan is first and foremost the fee that the borrowers pay to HUD, that's the Department of Housing and Urban Development, in order to insure this loan. All right. And now that fee is 2% of the value of the property. Okay. Up to this maximum claim amount that HUD limits, which is $1,089,300. Now that I don't mean to throw out numbers like that, but so the maximum upfront mortgage insurance premium that a borrower will pay is 2% of $1,089,300. So even if somebody has a $1.5 million house, they can do this loan, but we're going to base all of our calculations on that maximum amount that HUD says we can. Okay. And so that
a good loan for someone in a $4 million house or a $5 million house, something. I mean, we have a lot of $1 million houses now in Washington State. So
absolutely. And so that's $20,000. If it's $1 million house, that fee that goes right to HUD is $20,000.
And I see. Okay.
So is that essentially paying mortgage insurance, but instead of a monthly with your mortgage payment, like a new borrow or an FHA, so you're paying the mortgage insurance up front?
It actually works exactly like FHA in that regard. Your traditional FHA loan has an upfront mortgage insurance premium and a monthly premium, right?
Okay.
And the home equity conversion mortgage, or HECM as we call them, that FHA insures, has that upfront premium, and then there's a monthly premium of 0.5% annually. So there is a monthly as well. Now, I do want to, if you can allow me the space to do this, it's like, wow, $20,000 sounds like a big big amount to do a mortgage loan. So what that does is that guarantees several things for the borrowers, right? So that insurance guarantees that no matter what happens, that borrower will always be able to live in that home and never have to repay that loan until the last remaining borrower permanently leaves the home. So even if the borrowers are moving, they're moving along wonderfully, their loan balance is going up because interest accrues on these, and let's just say property values drop below that loan balance. Well, because of this insurance premium and because it's insured by HUD pays the lender for their loan no matter what. And the borrower still is able to live in that home the rest of their lives. And it's because all of these borrowers that pay this mortgage insurance premium into HUD when they do these loans create this pool of money available. So lenders will lend on the product, and it protects the homeowners from never being responsible for any amount of the value of the loan over the property value. And so that's one guarantee. Again, if a borrower has a line of credit associated with one of these reverse mortgage loans, because that's a way you can get your money is through a reverse line of credit, then even if the lender that's doing that loan goes out of business, and even if the property value drops below the value of that loan, that line of credit is insured by HUD and guaranteed never to go away, never to be canceled. And I can tell you from personal experience, when our home value went down in 2009 and 10, we got a letter from our bank saying, I'm sorry, your home value declined. We're freezing your line of credit. Even though our payment history was good, even though, we had made all our payments on time and we're intending to live in there, we didn't have access to that money anymore. Imagine if you're very far along in your life and you're relying on that line of credit to help you with emergencies or funds, and then getting a letter from your lender saying, sorry, that money's not available to you anymore. So that's another thing that upfront fee to HUD guarantees or ensures for the borrower that their money's always available. And also their heirs or their estate will never be responsible for paying off a reverse mortgage. These loans are what we call non-recourse, which means only the property secures the loan. Even if somebody lives a super long time and they're upside down in the loan when they die, the estate is not responsible for any amount of that.
But now, if the home does appreciate and it's worth more than the loan, then the balance, the loan would be taken out, paid off if someone passes away or sells, and then the balance would be part of the estate, or the owner would be able to do whatever they were going to do with that balance. Correct?
Absolutely. That works just like a traditional mortgage. If mom and dad pass away and they've got a regular first mortgage on the property and there's equity and the kids decide, do we want to keep the house? And they pay that loan off, right? And then they keep the house. Or do we want to sell the house and get the equity? Then they do that. The payoff on a reverse mortgage is the same as a payoff on a traditional mortgage, actually. I love these questions. I get to educate people.
Well, I hear people say things like, well, I've got a reverse mortgage, so, when I die, my home goes to the bank. Is that correct?
No, not categorically. I could imagine a situation where if somebody passes away, the heirs don't want the house, and the loan balance is more than the property, then sure, then the bank gets the house. But if there's equity, it's exactly what I said. Then the heirs can decide whether they want to keep the home, get their own conventional mortgage to pay the loan off, or they want to sell the house and keep the remaining funds. That's their choice. And another thing that fee guarantees, in the case where an heir may want to keep the home, even in the situation if the loan balance is higher than the property value, the payoff, this is another thing that the fee guarantees, the payoff on a reverse mortgage can never be more than the property value. Actually, never be more than 95% of the property value. And so for any real estate professionals listening, that means that they could qualify for your regular conventional loan if they wanted to keep the house. Even if the house was upside down $100,000-$200,000, if we had a terrible real estate correction and they wanted to keep the house, HUD pays the difference and the heirs can keep that house. So the payoff is never more than the property value.
And by that, you're just saying that the heirs could get a conventional loan and pay off the loan and keep the house because, that makes, wow, I was not aware of that.
Are there different kinds of reverse mortgages, or is it just kind of all one package?
There are. So the primary one that we talk about is the one insured is the HUD, is the home equity conversion mortgage by FHA. Now, Judy, you had mentioned, $2 million, $3 million, $4 million homes. Mm-hmm. We do have what we call proprietary reverse mortgages, which are not part of HUD, and we also call them jumbo reverse mortgages. So if somebody does have a higher value property and they want to take advantages of a reverse mortgage, those are options. Now, they vary by state, the way those loans work, but it is a solution for people in certain circumstances to use one of these proprietary products. Fundamentally, they work the same, but there are differeces that quite likely go beyond the scope of our time here.
So on the HUD reverse mortgage that we were initially talking about, that's nationwide, correct? That's a federal program. So anyone because we do have people that listen from other states. So.
Yeah, absolutely. So the rules that govern how those loans are done come from HUD. And so somebody doing a home equity conversion mortgage in Florida is going to have the same requirements and protections as another person doing FHA home equity conversion mortgage in Wisconsin.
But the jumbo ones are the ones that are different.
Those are going to vary. And there are certain state overlays that have some nuances, but it's, HUD gives us the formula regarding how much somebody qualifies for in terms of the proceeds they may be able to get from a reverse mortgage. So that won't vary. Like you can talk to me, and if you go talk to two other people about an FHA loan, as long as we're using the same appraised value and margin on the interest rate and borrower age, there's not going to be any difference on those loan amounts. So
clarify, the amount that they receive is based on the appraisal and on the age of the borrower, correct?
Mm-hmm. Yes.
So is there a percentage? Could you say you get 75%, you get whatever of the value? Is there some rough idea?
Yes. Yeah, no, there is. So it changes from year to year because also the prevailing interest rates are factored in there as well. And then HUD also revises their principal tables that we use to determine this from year to year. But right now, at the time of this recording, you're looking at about 32% equity that somebody at age 62 could access. Okay. So 32% of the home value, and that maximizes at just over 70% as we get older. So there's not a lot of difference between what I can loan an 85-year-old borrower and a 90-year-old borrower. So it kind of goes like this, and then it sort of maxes out at a point. But it's really between about 32 and 72% of equity or of value of the home that one can access depending upon their age.
But now if you're picking up, say the home has already got a loan on it, and that's going to be rolled into the new reverse mortgage, that's inclusive in that 32 to 70 some odd percent. Okay.
It is, yes. So once we pay off that loan, if they don't have a mortgage on it, then I can tell a borrower, hey, you have access to this much money, right?
Right.
But if they do have a loan, I say, well, we have to pay this loan off, so you have access to this much money.
Okay.
Right. But we've eliminated their mortgage payment. And that's one of the main reasons that people do this. Other than accessing the cash, somebody with a mortgage that's 78 years old trying to retire, is really going to be benefiting from not having to make that mortgage payment.
Well, and I think when we were talking to one of our other guests was talking about, when people stay in their homes, part of the problem is maintaining the home, having the funds to maintain the home if it needs a new roof or it needs whatever. And this would, even if it's a small amount, it would probably address that issue. Their payment goes away and there's some protection there to maintain the home so the value stays.
Absolutely. No, my last client, I can give you a real life example. One of my last clients, she was referred to me by her financial planner who I met with because I do work with a lot of financial planners, and she was having to take a lot of money out of her investments to meet her expenses. And she needed to do her floors and she needed to do a lot of things. So he said, maybe you need to call Frank and see if this is a good solution for you. And we did a reverse mortgage for her, and I eliminated her mortgage payment. And she has access to a line of credit that she used to redo all the floors in her house. She's super happy. She doesn't have a mortgage payment anymore. Her financial planner is working with her to budget for paying the taxes and insurance, which she could actually use the reverse mortgage to do that. But yes, this mortgage allowed her to preserve her investment account so she could have a better quality of life, improve her home so she feels wonderful that she has these nice new floors, and she doesn't have a mortgage payment anymore. She loves this. And there's so many people in that same situation.
So we've talked a lot about benefits of the reverse mortgage programs. Are there any downsides to it that people should be aware of, or?
Sure. So the downsides to the reverse mortgage, we look at basically, and I'll answer this in this way. There are basically three groups of people who aren't really good candidates for a reverse mortgage. The first group are people that, if you're not intending to live in your home for at least 3 years or longer, then this is a very expensive way to do it.
Yeah.
Right. So, when you look at these loans, the upfront costs over time make sense. And typically that's about 3 years or longer. And so the costs sort of distribute themselves out over time based on the additional benefits. But that's one downside. Is you don't want to do this loan if you're planning on moving next year. I actually have clients that we had that conversation. I said, okay, well, this is not the solution for you because it's a really expensive way to get access to your money. The other group of people that aren't really good candidates, I would say in general, are people who, let me put it this way. If you are a person that doesn't manage your money very well, right? You spend every dollar that you have, and you're always, you're just having trouble managing your finances. Suddenly having access to all of this home equity could be problematic, because if you were to spend it all, then you're not really helping yourself.
No.
So there could be a disadvantage for someone who's not getting professional advice, who doesn't really have the discipline or the practical behaviors to use the funds judiciously. And I'm not saying, people should travel with this. These loans, they're to help people have fun and do things in retirement rather than not. But what we found is people who really, really have trouble budgeting and managing their funds are not the best candidates, because you can spend all. That is one of the things that happened in the past with some of the product changes. We eradicated it, but people would get a reverse mortgage and they would spend all of their available funds the first year.
Oh boy.
They would just spend it all. They would just buy, do, I don't know, whatever, but they would just blow it all in the first year. Well, then what happens is they don't have money to pay their taxes anymore, and they're in the same financial situation that they were in before. Yes, they can live in the home the rest of their life, but do they have the financial resources to pay their taxes, pay their insurance, to buy food? And so those people in general are not the best candidates. And so
is that something that can you determine that in the process?
I love that you asked that question, because the safeguards that HUD put in to protect against that are, one, HUD limits how much you can access in a reverse mortgage in the first year.
Oh, okay.
Right? So I won't go over the exact details, but basically, overall, you might be able to get this much. Well, HUD says, okay, but your first year limit is this much. Mm-hmm. And what they found is that if people could get through the first year managing their money on what they let them have in the first year, then they were more likely to be successful. So that's one safeguard that was actually put in place on the loans to protect against that. The other one is that these mortgages require the borrowers to go to a HUD-approved counselor. So the counselor is a third party. I cannot tell them who to go to. I give them a list of available HUD counselors, and they pick from one of those lists. And the counselor does basically a financial consultation with them to make sure they understand the mortgage, to make sure that they understand the risks and the benefits, and they look at their finances, they look at their monthly bills, and they give them an opportunity to walk through with the borrowers to kind of understand how best to manage their financing. And that was a requirement that the counseling became mandatory sometime between 2014 and 16 as well. And then, yes, to answer your question directly, that is, I'm measured by how successful my borrowers are. So if I'm working with a borrower and it appears that, they're maybe at risk of not being successful with this loan, then I'm going to have that hard conversation with them. And there are other safeguards I can help them put in place to ensure that they're successful. And I can kind of tell you some of those if you'd like, but I don't know how detailed you want to get. But yes, so there are a lot of ways we can manage helping a borrower ensure that they know how to behave, how to be successful, and use this money to enrich the quality of their lives and not just blow it and be in the same place that they were before they came to.
Mm-hmm.
Okay, we talked about two people. One, if you're going to move early, and two, if you don't manage your money very well. What's the third?
Oh, the third is, what we've found is looking at all of these borrowers, the third is somebody who doesn't really understand why they're getting it. If they don't really have a clear purpose, I want to eliminate my mortgage payment, I want to make sure I can travel more, or, have really some specific reasons to get it, then, they probably shouldn't get one. And it's kind of, maybe that sounds generic or vague, but there are definitely people out there that could benefit, but either, they just don't understand it or don't want to take the time to understand it and don't really know why they're doing it. And that's not a good candidate for the loan. But as far as the product itself, the downsides and the risks of the products are there's an interest rate on it. It's a loan. The loan balance will grow over time. You will consume a little bit of home equity doing a reverse mortgage. The question
you're not
is
paying it, so it's being added on top.
Right. If you choose not to pay it, you can make optional payments. There are some great reasons to make voluntary or optional payments on a reverse mortgage. Really powerful, strong financial reasons why somebody might want to do that. From saving money on taxes, from increasing their overall investment, from increasing the availability of future funds. Right. So somebody who's still working, for example, who gets a reverse mortgage at an early age and they're still working, if they still pretend like they have a mandatory mortgage payment, and so they decide to make the same monthly mortgage payment that they've always been making, well, what happened is they pay the interest on the loan, so the loan's not growing, right? Mm-hmm. So they keep the loan balance, but every dollar that person pays into that reverse mortgage becomes available to them to reborrow for any purpose at any time. So they're basically paying themselves for access to that money later on when they do become retired. So it's a way to dramatically increase how much someone has access to later in life just by getting it earlier. So that's an advantage. But if somebody doesn't choose not to make their payments because they're voluntary, then yes, you're going to consume equity. This is again, it is a commercial product. There's an interest rate on it.
So I have this is probably a kind of a crazy question. What if someone wants to buy a house? Can they do that with a reverse mortgage?
It's not a crazy question. And yes, you can. That's one thing that I really have talked to a lot of real estate professionals about when I do seminars and continuing education is how to use this for a person who is of age to purchase a home, right? So in a lot of cases, an older borrower, let's just say if they're downsizing or they want to move closer to their grandkids and they sell their house here and then want to move here. So generally, the options are either pay cash for the house, right? Or get a traditional loan.
Mm-hmm.
Well, paying cash for the house is great because what do they not have? They don't have a mortgage payment.
Mm-hmm.
If they get a traditional loan, they don't have to spend as much of their cash, but they have a mortgage payment.
Mm-hmm.
Well, with the reverse mortgage, they can use some of their cash, put down a large down payment, keep the other bucket of cash that they would have spent, and guess what they don't have now?
A mortgage
A
payment.
mortgage payment.
Brilliant.
So that puts them in more control of their liquid funds, right? And we know, having access and being able to access money for emergencies for any purpose is really valuable. So it's a very powerful way for someone who is over 62 to use this program to keep more of their own money in their bank account with their financial advisor, qualify, get the reverse mortgage, make those payments voluntary, and be able to live in that home the rest of their life without making a mortgage payment if they want. So yes, there are.
And how do they qualify? What would, beyond their age, are there any? Because a lot of those people are probably retiring and.
Yeah. Well, it's the same way as if you already owned your home.
Okay.
So we pretend like you do own the home. We get that appraisal and you're at a certain age. And let's just say that you qualify for 40% of the value of that property on a reverse mortgage. So, we used $1 million house before, right? So let's just use that example again. This borrower, based on their age and the appraised value being $1 million, and the rates at the time, they qualify for 40% proceeds from a reverse mortgage. So they're going to take their $600,000 as a down payment. We're going to loan them $400,000 on the reverse mortgage, and we close on the home.
Wow.
And now, instead of them writing a check for $1 million to buy this house, they write a check for $600,000, and they've got $400,000 to go give to Edward Jones, or they're safe in the bedroom or wherever, whatever they want to do with it, and they still don't have a mortgage payment for the rest of their life, and they have an extra $400,000 that they can use, and buy insurance for their kids, whatever.
But you can't use this on a second home, though, a vacation home.
Exactly. You must occupy the property as your primary residence, and the rule is you have to live in the property for most of a year. A lot of us in this part of the area, they like to live in the homes in the summertime, and then Arizona becomes a very attractive place around January. So they go spend a few months in Arizona, right? So as long as the home remains your primary residence, you live in the house for most of the year. There's some other nuances that HUD has to expand possibilities. I think, maybe a couple wants to go on a missionary trip for some reason. With the proper communication, as long as that property is the primary residence, then you can get the loan. But yes, no, it does not work on second homes, does not work on investment property. You cannot get one of these loans as an owner-occupied property and then move out of it. There are annual occupancy certifications that do happen. It's not like a traditional loan where, you can get your loan, and as long as the lender keeps getting their money, they don't care where you go. This loan, you have to stay, you have to live there. And that's
every year.
Not each year,
but every year.
Every year. As long as you have that loan, that's the requirement. At least one borrower must occupy the property as their primary residence. And once the last remaining borrower departs that residence for more than 1 year, the loan becomes due and payable.
Wow, I've learned more, Frank.
That's good. I'm so grateful for this opportunity to share.
And I think in our market, well, at least so far, since 2010, we have, not really, we lost maybe a little bit last year. It seems to be coming back in terms of appreciation on property. At one point I did, and this was probably around 2010, I had a potential client who had a reverse mortgage, and she wanted to see if it was going to work for her to be able to sell the home. And at that point, she had lost equity, and so she did owe more than the mortgage, the reverse mortgage was worth. And so it did not work out for her at that point in time. But so when you talk about how HUD can change requirements and change how the reverse mortgage works, if someone buys a home under a reverse mortgage and the requirements and the operation rules, I don't know what else to call it, of the mortgage that they accepted the time they signed, if they're changed next year, does it go back and reflect on their current mortgage, or do they stay with what they accepted in their? Does that make sense to you?
No, it does. And so you answered your own question. No, they get to live and operate under the terms of that loan that they got at the time they received that loan.
Okay, great. Even if
HUD changes their stuff, right?
Yeah.
And sometimes it gets better, right? So sometimes it gets better, so people can have a benefit of being in a reverse and years later refinancing into a new reverse. That can be a benefit.
Refinance.
But no, once they get that they if HUD says changes something that makes it more restrictive, let's say, they are
grandfathered
that
in.
Deed of trust. Well, they're not grandfathered in. The controlling or the operating document is the deed of trust in the mortgage note. So all the terms and conditions are recorded as public record, and it's a legal document. It's binding, so they don't have to abide by the new ones. But there are cases where they can really benefit. A lot of people, when the rates went down, did refinances like that to get more money.
Do you keep in contact with your clients once they close? And if something like that happens where maybe rates are better or whatever, that they could
definitely more so than your traditional loans. I am frequently in contact with the borrowers that I close. I mean, they call me when they get their tax bill, they get their monthly statement and they want to figure out how to get a draw. They call me. I mean, I spend so much time with my borrowers and the people that I work with to do this loan that we've become very close. The group of people that this loan is for really appreciate that hands-on approach, and they love to just be able to pick up the phone and text me and call me. I mean, I'm taking one of my past borrowers out to lunch here next week because she just likes to go eat tacos with me every couple of months, and we do it. So yeah, that's one of the things that I personally love about these loans and working with these borrowers is I have really sincerely good relationships with them, and I'm happy to help them in many ways. Even just setting up their online account when they get their loan, how to access their money, how to see what it is, even though they get monthly statements. I helped borrowers actually help them understand that they could qualify for a senior tax exemption. They didn't even know how to do it, and I helped them through getting the senior tax exemption just because I knew it would help them out. So to answer your question, I remain in contact with all of my borrowers. Some reach out to me more than others, but definitely if there's an opportunity, if there's something that's important for them to know, then I like to maintain that relationship.
I know for years I was very, I had heard they were scams and that they weren't good. And to this day, people still think that. But the first time that I saw you speak, I was really impressed at how much that this loan product has changed. And I really think it's a really good tool for a lot of people that are considering downsizing and to help them out during their past working age. So
it definitely is. And we have a very large wave of people retiring in this country.
We do.
10,000 people a day for the next 20 years are turning 62 in this country.
Hey, Frank,
yes, sir.
Can I ask you what this big rise in interest rates this year and recently, how has that affected the reverse mortgage?
The main impact it had on reverse mortgages was, remember I said one of the factors we use in determining how much someone can borrow is the prevailing interest rates at the time. And so when the rates went up, the amount of loan that we could extend to the borrowers went down. And so as rates go higher, what we can loan to borrowers goes less. And that's because if rates are higher, interest is going to accrue faster. So they limit the amount that you can borrow. But that's the main impact, is just that the principal limits, that's what we call it in reverse mortgage. But the loan amount for the purposes of this meeting here is less when the rates are higher.
Are the rates tied at all to the borrower's credit ratings?
Oh, great question. No.
Okay.
There is a credit assessment on these loans, but it doesn't have any impact on the interest rate that they pay, the costs that they pay, or any feature like that. It is not credit score driven. There's no minimum credit score. Now, if someone has some credit that has challenges on it, if they have late payments on their mortgage, for example, or late payments on installment accounts, or late property taxes, these things, we will still be able to do, in most cases, a reverse mortgage for them. But remember when I said that the borrower has to pay their property taxes and their insurance and maintain the property? In cases where a borrower doesn't meet the requirements of the credit review, then the lender puts what we call a set aside. So we reserve some of the money that we would have been able to loan them and
sort
put
of
it
like
over.
An escrow?
Sort of like an escrow account. It is like an escrow account, but it's an escrow account that we fully fund for the rest of their lives.
Oh, wow.
So it's a big account, but it's not real. It's not real. We just say, okay, if I can loan you, you're going to get a line of credit, or you have access to $200,000, right? But we determined that for some reason, you can't make your own taxes and your insurance. And so we're going to make them for you. And the calculation for the property charges for the rest of your life is $100,000. Then suddenly we're only going to let you have access to $100,000.
Okay.
And the remaining is going to be set aside to pay your taxes and to pay your insurance each month.
Okay.
I just had a borrower close for this very reason, but that's why he wanted to do it anyway. He has very expensive property taxes. He was trying to decide whether or not he wanted to retire. And one of the critical things was his property taxes were very expensive. And so he's happy that he has this set aside, because he knows that he can retire now and not have to worry about his taxes or his insurance for the rest of his life.
Wow.
And the interest only accrues when it's actually distributed. So the set aside is just, we're not going to let you touch this. We're going to just pay your taxes and your insurance out of it. And here's your bucket that you can have for your line of credit, your monthly payments, or your lump sum. A lot of information.
A lot of information. I have questions about the options people have with a reverse mortgage, that they get into it, they have limits in how much they can take the first year. Are there other options like having a monthly payment or a lump sum per year, or even a giant lump sum to buy an RV? Great. Yes. So there are three ways you can get your money, right? And you actually touched on all three of them, right? So the first one would be monthly payments, okay? And there's two types of monthly payments you can get. So on the one hand, we can say, I just want monthly payments for the rest of my life. Tell me how much I can qualify for, right? And there's a calculation that HUD uses based on how much we can loan you, and says, okay, you're going to get $1,000 a month out of this loan for the rest of your life. And set it and forget it. So monthly payments. The other one is, let's just say, for example, somebody says, well, I want monthly payments, but I don't need them for the rest of my life. I really just want monthly payments until I apply or qualify, or until I want to start taking Social Security. And so I'm gonna apply for Social Security in 3 years. I want monthly payments for 3 years, and then I want to handle the rest later. Those are the two options for monthly payments. You determine either for life or a temporary period of time. The other option is, I want a certain amount of money in cash because I want to buy an RV, and my RV is going to be $100,000 or whatever it is. And if you have
access to that much money and you want an RV, then at closing, title or escrow company is going to cut you or wire you $100,000 into your account, and then you can go buy your RV. And whatever is left over, if you haven't used all of it, you could have on the third option, which is a line of credit. And that works really similarly to a traditional home equity line of credit, in that you have access to this amount of money that you can draw on for any purpose at any time and use it. And only money that you've borrowed, that you've actually taken from that line of credit, goes into the loan that starts accruing interest. Now, each one of those three, monthly payments, cash, and line of credit, you can do any one, a two, or a combination of all three of those things. So that's why you have to sit down with someone to kind of figure out these options, but you do have lots of different options.
Well, that's fantastic. Frank, I took your little seminar and I've learned so much more again.
Right.
You've been so helpful. Thank you. I think this will help people understand.
Yeah. Is there anything else we're missing? Anything we haven't touched on that?
Yeah, I'll tell you just directly to all of your listeners, don't be afraid to get a consultation. That's it. These loans take a lot of time to understand. They've changed. Reverse mortgages got seatbelts and airbags between 2014 and 16, and they're not what you think they are. That's the message that I want to get out, is people have the wrong idea about this. There is no downside to exploring or investigating how this may work for an individual. And that's what I'm here to do. So, and if it's not me, do your own investigation, learn more about them, call somebody else, but don't wait until later to just find out about them. Because what I'll tell you is that every loan officer in my branch who is over 62 has a reverse mortgage.
Wow.
I will get a reverse mortgage when I'm 62. I'd say most people in my company at Fairway Independent Mortgage Company who are eligible, who own their homes and have enough equity, have reverse mortgages. 90% of people who get reverse mortgages are satisfied to extremely satisfied. So there's a lot of fear in just having the conversation. And so I just want to help people open up to exploring. Go ahead. You were going to ask me a question.
What if someone has a home with a reverse mortgage and they do decide to sell and there's some equity there and they're going to buy again? They could close out that one reverse mortgage and get another one if they wanted to.
Absolutely.
Is your consultation free?
Absolutely. It's totally free to speak with me. I mean, this is it's a product and a service, and I'm compensated to do reverse mortgages, but just the same as y'all, you don't charge borrowers up front to show them lots of houses. So the more people that I can help and that I can talk to and share the story about reverse mortgages, the better it's going to be for everybody in the country. So no, they should call me without hesitation, and I will, educate anyone.
Can you help people out of the state of Washington, or can you refer them to someone out of the state of Washington if we have any listeners out of state?
Absolutely. We are under state licensing. So I can originate personally in Washington and Texas. I have other loan officers in my office who are licensed in other states. And if nobody, let's just say in my office, is licensed to originate in a state where you have somebody, then I can refer them internally in Fairway. We have a very strong reverse mortgage lending division. We're one of the top reverse mortgage lending institutions in the nation, second in reverse for purchases. We've been the fourth largest lender for your regular traditional reverse mortgages. Our company spends a lot of time and resources on making sure that the loan officers at Fairway who do these loans follow a very consultative, educational approach. This is a very consultative process. And so, yes, I would be able to refer anybody to any state.
So we will be posting your information on our podcast, but just to let people know, how can they get a hold of you? What's the best way?
The best way, you can go to my website, which is my last name, Borg Reverse, and
Okay.
that'll just take you right to my landing page. That's the most efficient way that I can tell you to do that. I can give you my phone number right here too.
Sure.
Or just pick up the phone and call me. That's 425-949-2889. My office is here in Linwood. I can see the Alderwood Mall right out my window. And so I'm local and I'm here to help.
Great information, Frank. Thank you so much. I think this can really help some people.
I hope it does.
So too.
Thank you.
I think you'll be getting some calls. So.
All right. Perfect.
That's it for today's episode, number 15 of Getting Your Edge, How to Right Size Your Home and Life podcast. We're so happy to be here. Thanks again, Frank Borg of Fairway Mortgage. And thank you, Judy.
Thank you, Dennis.
And that's it. We'll see you next time. That's it, folks. Thanks for listening. And stay tuned for future episodes wherever you get your podcasts. Thanks. Goodbye.